Welcome back, traders and investors. Our final guest today is Thomas Sudyka. Now, Thomas is president of Lawson Kroeker Investment Management, and he is portfolio manager at the LK Balance Fund. How you doing this morning, Tom?
Oh, great. Training here, but pretty good.
Okay. Can you just give us a little bit of like your education and your market background?
Sure. I went to Creighton University here in Omaha, Nebraska, then got a master's, an MBA at University of Nebraska-Lincoln. I've been in the business for 30-some years now, primarily a mix of both bond jobs and stock jobs, and hence I ended up running a balanced fund later in life.
Okay, I guess I won't hold it against you that you went to Nebraska.
I try to. Most people appreciate that, actually, unless they went to Ohio State or Michigan.
Okay. All right. So let's talk about your investment style. How would you classify it? Like, what are your time horizons?
Uh, I would classify our investment style as a kind of a go anywhere, but with a very focused long-term approach. We like to hold things for 3 to 5 years, and then we're not very technically oriented. We're pretty much fundamentals. So we're looking at research reports and company annual reports and digging into the numbers, not necessarily into the where it's been yesterday kind of line stuff.
So would you say you're like 90% fundamental and 10% technical? Do you do any technicals? Do you leave that to somebody else, or you just put it in the rearview mirror?
I think we use the technicals in the sense that, yes, we put a chart up and we'll say, oh, it's going up or it's going down and it's above or below its 50 or 200-day moving average. But we really use the technicals to say, it's going down. What are we missing? It's kind of a contrary indicator for us, or confirming if it's going the direction we might want it to be. But we're probably closer to 98% fundamental and 2% technical. None of us here are very good at reading the charts, and so we try not to.
Okay. And so let's talk about your fund, the balance fund. What are you investing in?
The balanced fund is about 60% stocks, and there we're holding 35 names across all sectors, individual securities, and then the offset, the 30% bonds currently, and about 10% cash. Normally it'd be 60% stocks and 40% bonds.
So you don't
Today, it's hard to buy bonds.
it's you don't mess with the individual ETFs then or something that you know.
We've used an ETF here or there just when we want to get quick exposure to a sector we like. But generally, we prefer to own individual securities because we can control, what we know a little bit better. We're not buying a basket, trying to bet on a theme necessarily. We're trying to get in bed with a management team that's got a product or an idea that we like and has proven their ability to make the company grow, and then hopefully, eventually the stock price follows the company's growth.
Do you use futures and options at all?
We don't use either futures or options. We're plain vanilla here in the Midwest, and we'd like to keep it that way.
Okay. And just from what you're saying, don't think you hedge your portfolio at all.
No, having a balanced product is kind of a hedge in and of itself. Most people buy a balanced product because they don't want to mess with the stock market up or down today and kind of take some of the volatility out of their own personal portfolio. And so, a balanced fund is perfect for that.
Okay. And last week or few weeks ago, we had some geopolitical events that kind of rocked the market. From what you're saying now, you just kind of ignore those things and stick with your fundamental analysis.
I think yes, except that you can't live in a bubble. I mean, we're in the Midwest. We're not immune to what's going on in the world, especially I think more on interest rates and where is the worldwide economy going. So I think we're very aware of them, but we try not to be reactive to them. I mean, we've got the 10th ceasefire in how many years now in the Middle East, and that'll be perceived probably as slightly good for a short period, but we're not going to try. We need to be aware in case something happens. Again, especially on the interest rate side with what's going on in the world economy. But we're not going to try to make a bet on defense stocks because another war broke out somewhere.
So, what is your take on interest rates here? I mean, the Fed has stated their case for tapering and is following through on it. Unemployment seems to be heading lower. I mean, you can always get into the argument about structural versus functional unemployment, but let's talk about interest rates here. What's your long and short term outlook for interest rates?
Right. Trying to make an exact prediction, I would say that it looks like the Fed effort to taper is working. We would suspect, like most economists and most prognosticators, that interest rates need to go up. If the Fed wasn't involved, they'd probably be higher. And as as they remove themselves from their various QE programs, we probably will get a drift back up in both short and long rates. But until the economy starts overheating and short rates come up sharply, which we're not seeing in the near term, it'll be a slow move. One of my partners here is 90, and he always asks the question, why were interest rates at 2% or why did my dad buy a 2.5% interest rate bond in the 40s or 50s? Well, that's all that was available. And I think it's going to take a few more years for the world to adjust to, but rates could stay low for a long, long time. They were there for 30 years prior to the most recent 30-year period, and they could go back there and stay right where they're at, right where we're at here. And so if we float between 2.5 and 4 for the next 5 to 10 years, based on where the economy's at, that wouldn't be out of the realm of history. Our mindset, mine being in the business for the last 30 years, is they should float back to 7 or 8, right? That's not where my older partners here are telling me that we could stay in the 2.5 to 4% rate now. And I kind of believe that it's hard to get back to 5 or 6 or 7 near term. X some shock to the system.
Yeah, I just don't see anything. I don't see it. Yeah, I don't see anything taking us back to. I think those days are long gone. I think that that your interest rate, your interest bear. I mean, at least for the short term here, are your dividend stocks. I mean, that is your substitute for a CD. Are you holding any dividend stocks in your portfolio?
We are. We like dividend stocks. It's not a primary reason to look at a company, but we do like dividends. I think you're exactly right. And at what point does the dividend rate on the S&P invert so you get more in yield than you would do on a treasury, right? And that could be coming again. That was normal until the early 60s. You got more in dividend yield than you did on a treasury, and we could be heading back there where companies return their cash flow to their shareholders better than they do with their bonds. So yeah, we like dividend-paying stocks, although it's not the only criteria we would look at. We're still looking at the lower PE, lower price to book, typical kind of valuation measures. But in a balanced portfolio, you need to get yield where you can get yield.
What about the market here, all-time highs? Is there anything on your buy radar here? Anything that still may have some upside? I mean, obviously the market can keep going, but is there anything that's pulled back? You mentioned a Tim Melvin term there, book value. Is there anything on your radar here we can alert our traders to?
I would have them go look at Chicago Bridge and Iron. Chicago Bridge and Iron is a company that had a short seller out there beating it down a couple months back and dropped from 90 to the low 60s. It's bouncing around the low 60s today. It's a great company. They're in an energy infrastructure. They've been growing nicely. Their second quarter earnings came in on schedule, a little bit ahead of most analyst estimates. Our other local investor here in town that's always in the news, Mr. Buffett.
I was just going to mention that. I was going to ask if you had lunch with Mr. Buffett on this one.
I did not. In fact, we got involved initially in '01, and then we bought heavily in '08 and '09, and we've owned it for a long time, and I don't think he got involved till 2013, and I would be remiss to say I did not tip him off. Nobody at the firm mentioned it to him. They apparently found it on their own somehow.
Yeah, he's actually been in this for a while, and then that last bump up in his latest filing, he revealed that he increased his position in the stocks. That's something that we keep an eye on. So that's one stock. Anything else that I like the chart of this one. I like buying stocks that have been beat up. And anything else on your buy radar?
On the opposite end, we also like to buy things that are in beaten up industries. So we've been buying a little company called Costamare, which is a Greek shipping company, CMRE. Uh, the story there is simply they're in a horrible industry worldwide. They build bulk container ships and then lease them out, and the that industry is in the dumps. I mean, world economy isn't great. We're shipping less goods between China and the U.S. and everywhere else, and the time for us, in our way of thinking, the time to buy securities is when they're beat up or when the industry is beat up. And so we got involved in this one a couple years back in the mid-teens, and it's had a nice pattern up recently. It's on a nice growth pattern, but the company has the financial strength to survive this downturn, we believe. And we'll wait for the turn. Don't know when the turn will come, but it will. And as the world economy grows, they'll continue to do well.
You don't short stocks, do you, Tom?
We do not short stocks.
Okay.
Just avoid them if we don't like them.
Probably not a good idea over the last 5 years, but okay. Just one more question. Just just your final thoughts at the market here, up at all-time highs, coming into a holiday. A lot of times you'll have a consolidation or a change in trend. What are you looking for post Labor Day?
Oh, post Labor Day, short-term forecasting, exactly what we try not to do here at Lawson Kroeker. But I would say that over time the market tracks the economy. The economy probably continues to do well, so we're going up, short and probably longer term. And until such time as we start to sniff a recession coming, and we don't sniff that right now.
Okay, all right. We've had Thomas Sudyka on the line, and he is president of Lawson Kroeker Investment Manager and a portfolio manager of their LK Balance Fund, giving us a level-headed, long-term outlook at the market, which we all need to do. Thanks a lot for coming on the show, and we'll speak to you again soon.
Thanks for having me, Joel.
Okay, thank you.